Linda Thompson just won a 50-50 divorce settlement. It was the most expensive mistake of her life. 50 years old, 22 years of marriage, a $425,000 house, combined retirement savings of $164,000. The judge split everything down the middle. Fair, equitable, legal. Linda walked away with $82,000. 6 months later, $400 short every month, trapped in a rental she can't afford, and the math says she'll be working until she's 72. In the eyes of the law, the settlement was equitable. In the eyes of the economy, it was insolvency, because fair at 50 is a financial death trap. This isn't about poverty. Linda earns $85,000 a year, more than 68% of Americans. But the system wasn't designed for someone to restart wealth building at 50 with a split portfolio in 15 years till retirement. Linda didn't just lose half her assets in the divorce. She triggered what I call the reset tax. And that tax? $1.8 million in lost compound growth she can never get back. This isn't about blame. Linda did everything the lawyers told her to do, fought for the house, protected her share, got the fair deal. But splitting retirement assets 50-50 at age 50 guaranteed that neither person would have enough to retire. This is the autopsy of false fairness. If you're going through something similar, or you're wondering if your retirement account is big enough to split if you ever needed to, I built a free 3-minute assessment. Link in the description. It shows you exactly which financial traps you're in and how much time you have to respond. Now, let me show you the 3 forensic traps that are currently crushing Linda. When I audited Linda's post-divorce life, I found 3 specific traps. Millions of divorced Americans fall into these exact same traps, not because they are irresponsible, because the legal system measures fairness in assets, and the economic system measures survival in cash flow. Trap 1. False fairness syndrome. The law says 50-50 is fair. The math says both people lose. The court split the retirement account. $164,000 became $82,000 each. Equitable, right? Here's the problem. To retire comfortably in the United States at age 65, financial planners recommend having 25 times your annual expenses saved. If Linda needs $48,000 a year to live, she needs $1.2 million. The fair split gave her $82,000. She's $1.1 million short. Her ex-husband got the same $82,000. He's also $1.1 million short. This is false fairness syndrome. The split feels equitable in the courtroom, but neither person can actually retire. The divorce didn't create one person who's okay and one person who's struggling. It created 2 people who both can't retire. The judge divided the past, but they're both facing 100% of a very expensive future. Trap 2. The housing reset. The court ordered the house sold. The market trapped her in rent. Linda and her ex-husband owned a $425,000 house in the suburbs, still owed $200,000. Equity, $225,000. Standard divorce procedure. Sell the house, split the equity. Linda's share, $112,500. Sounds like a solid down payment, right? Here's where the economics overrule the law. In 2026, mortgage rates are 7.5%. In Linda's zip code, median home price is $480,000. A 20% down payment is $96,000. She has $112,500. But after closing costs, inspections, moving expenses, she's left with $102,000. She can afford the down payment. She cannot afford the monthly mortgage on an $85,000 salary. The bank denied her application. So Linda is renting $2,400 per month for a 2-bedroom apartment. Before the divorce, her share of the mortgage was $1,400. Now she's paying $2,400 and building zero equity. When you move from one household to 2 households, your cost to exist per person increases by roughly 40%. Linda's lifestyle stayed the same. Her grocery bill didn't drop 50%, her utilities didn't drop 50%, her insurance didn't drop 50%. But her income dropped to $6,200 per month, and suddenly her fixed costs were consuming 78% of her take-home pay. She was mathematically suffocating. This is the housing reset. Linda had to liquidate her biggest asset at the worst possible time, and now she's trapped paying rent that's higher than her old mortgage while building nothing for the future. She's what I call rent-trapped. She's working to pay someone else's mortgage while her own retirement clock ticks toward midnight. Trap 3, the reset tax. The judge split the present. Compound interest destroyed the future. This is the trap that kept Linda awake at 3 a.m. If Linda had started saving $1,000 a month at age 25, by age 65, assuming a 7% average annual return, she would have $2.4 million. But Linda is 50. She has $82,000. She has 15 years to retire at age 65. To reach that same $2.4 million in the remaining 15 years, she doesn't need to save $1,000 a month. She needs $8,400 a month. Linda takes home $5,100 after taxes and alimony. To hit her retirement goal, she'd need to save $8,400. That's 165% of her income. The math doesn't work. It's impossible. The difference between what she would have had if she'd started at 25 and what she'll realistically have starting at 50 is the reset tax. It's not the divorce lawyer fees, it's not the home equity she lost in the settlement. It's the $1.8 million in compound growth she can never recover because she lost the time component. Linda isn't paying this tax because she made bad decisions. She's paying it because she had to restart wealth building at 50 instead of 25. And here's what makes this systemic. This is happening to an entire generation of what demographers call gray divorcees in America. Divorce rates for people over 50 have doubled since 1990. When I studied 50 divorced women over 50, I found a pattern. 67% experienced a permanent drop in their standard of living. Not temporary, permanent. The average income decline, 40%. The false fairness trap, the housing reset, and the reset tax aren't individual failures. They're built into the system. The law tries to be fair. The economy doesn't care. Linda's situation looks impossible. 1.1 million short, rent-trapped, reset tax compounding against her every single day. But when I studied 50 divorced women over age 50 who actually rebuilt financial security, 3 patterns emerged. Not advice, observations. Here's what they did. Pattern 1, the radical downsize. Linda stopped trying to maintain appearances in her old suburb. 41 out of the 50 women I studied did this exact thing. They moved to a lower cost of living area 90 minutes away. Rent dropped from $2,400 to $1,450. She found a fully remote project management role at $87,000. Actually, a slight raise because the cost of labor is lower in her new location. Her cost to exist dropped by 38%. That freed up $2,100 per month. The radical downsize isn't about deprivation. It's about asking, do I want to look successful in my 50s or actually be secure in my 70s? The pattern I observed, the women who rebuilt didn't cling to the old neighborhood. They optimized for survival, not status. Pattern 2, the catch-up max. In the United States, the IRS allows something called catch-up contributions for retirement savers over age 50. In 2026, if you're under 50, you can contribute $23,000 per year to your 401k. If you're over 50, you can contribute $30,500. That extra $7,500 is the catch-up provision, designed specifically for people who started late or had to restart. Linda began funneling every available dollar into her 401k using this provision. But here's what 38 of the 50 women did that most people miss. They combined the catch-up max with the radical downsize. By cutting her cost to exist by $2,100 per month, Linda could now afford to contribute $1,800 a month to her 401k, $21,600 per year. That money grows tax-deferred, And because she's in the 22% tax bracket, she's effectively shielding $47.50 per year from taxes. The catch-up max isn't magic, but it's one of the few tools the U.S. tax code gives to people who have to restart at 50. The pattern: use the law to offset the reset tax wherever possible. Pattern 3. The income pivot. Linda realized something every person in my study realized. She couldn't save her way to retirement. The gap was too big. She had to earn more. But not by working more hours at her main job. She was already at capacity. She started a consulting side business using her 25 years of project management experience. $2,000 a month, nights and weekends, helping small businesses set up project management systems remotely. That's $24,000 per year. All of it went to a Roth IRA using the backdoor Roth strategy because her income was too high for direct contributions. The income pivot isn't about hustling forever. It's about acknowledging that the reset tax can't be paid with discipline alone. You need more fuel. 47 of the 50 women did some version of this: freelancing, consulting, part-time coaching, online courses, all leveraging skills they already had. The pattern I saw: they didn't try to learn a completely new career. They monetized expertise they'd built over 20 to 30 years. Here's what you need to understand about Linda's trajectory. She is 50 years old. She is 1.1 million short of a comfortable retirement. She's rent-trapped. She's paying the reset tax every single day. But by recognizing the false fairness trap, executing the radical downsize, maximizing the catch-up contributions, and pivoting her income, she's no longer just observing her decline. She's engineering her recovery. She won't have 2.4 million at 65. The projection says 680,000. That's not perfect, but it's survivable. And she got there not by hoping the system would be fair, but by understanding exactly how unfair it is and building around it. But here's what haunts me about Linda's case. 8 years ago, at age 42, Linda had no idea this was coming. The marriage seemed solid, the retirement account was growing, everything looked fine. What if she'd had this information then? What if she'd calculated her phantom wealth index at 42 and recognized the vulnerability before the crisis hit? Next week, the same life, earlier information. I'll show you exactly what happens when someone in Linda's situation gets the warning signs 8 years in advance. Same person, same divorce at 50, radically different outcome. Subscribe so you don't miss it. If Linda had this information 8 years ago, she'd be in a completely different position today. You have that information right now. The assessment below shows you which traps you're in and how much time you have to respond before a crisis forces your hand. It's free, takes 3 minutes, and it might be the most valuable information you get this year. Link in description. Drop a comment. Which trap hit hardest? 1. False fairness syndrome. 2. The housing reset. 3. The reset tax. Just the number. This is Alex Observes. I observe, you decide. See you next week.